Today, we're diving into a fascinating topic: how rich and poor people invest their money differently. These differences often highlight the mindset, opportunities, and strategies that people use in different financial brackets. Let's explore. Let's face it, in today's society, the way you handle your finances can significantly impact your quality of life. Investment is a crucial part of wealth building, but it often looks different depending on an individual's socioeconomic status. Understanding these differences can help us gain insights that might influence our financial strategies, regardless of where we start. In this video, we will explore various aspects that set apart the investment strategies of wealthy individuals from those who are less affluent. We'll analyze their mindsets, their approaches to risk, their strategies for diversifying their portfolios, and the resources available to them. But it's not just about investing, it's about financial literacy, empowerment, and understanding that wealth building is a journey that requires knowledge, strategizing, and sometimes a strong community. So if you've ever been curious about how to think like a wealthy investor, or if you seek to enhance your financial intelligence, stay with us. By the end of this video, you'll walk away with invaluable insights that could fundamentally change your approach to investing. Let's get started. Before we dive into the specifics of how rich and poor people invest differently, it's essential to understand the basics of investment itself. At its core, investing is the act of allocating resources, usually money, in hopes of generating income or profit. This could involve buying assets like stocks, bonds, real estate, or even starting a business. The goal of investing is to put your money to work so that it grows over time, ideally providing returns that outpace inflation and help you build wealth. However, investing is not a one-size-fits-all approach, and the strategies employed can vary widely based on one's financial situation, goals, and risk tolerance. Investing involves understanding different asset classes, which are broad categories of investments that exhibit similar characteristics and behave similarly in the marketplace. The most common asset classes include 1. Stocks. 2. When you invest in stocks, you're buying a share of ownership in a company. Stocks can be volatile but generally offer the potential for high returns over the long term. Investors typically focus on how well a company is performing or its future growth potential. 3. Bonds. 4. Bonds are essentially loans that you give to governments or corporations in exchange for periodic interest payments, plus the return of the bond's face value when it matures. They are generally considered safer than stocks and are often used to balance a portfolio. 5. Real estate. 6. Investing in real estate involves purchasing properties to generate rental income or to sell at a profit. It requires significant capital and is often seen as a more stable investment compared to stocks. 7. Mutual funds and ETFs, exchange-traded funds. 8. These are vehicles that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. They allow investors to diversify their holdings without having to purchase individual stocks or bonds themselves. 9. Alternative investments. 10. This category includes assets like commodities, cryptocurrencies, and collectibles. These can offer unique opportunities, but also come with higher risk and less liquidity. One of the key foundations of successful investing is compounding. Compounding refers to the process where the returns on an investment grow over time, generating earnings based on both the initial principal and the accumulated interest. Essentially, the earlier you start investing, the more time your money has to grow, highlighting the importance of starting as soon as possible, regardless of the amount you can invest. Another critical concept in investing is risk versus reward. Generally, investments that offer higher potential returns also come with higher risks. Understanding your risk tolerance, essentially how much volatility or loss you can accept in pursuit of higher returns, is crucial. Wealthy individuals often have a higher risk tolerance as they have more resources to absorb any potential losses. Additionally, diversification is a cornerstone of wealthy individuals' investment strategies. They often allocate their money across different asset classes, such as stocks, bonds, real estate, and alternative investments, rather than focusing on a single type of investment. Diversification serves to reduce risk. One critical advantage wealthy individuals have is access to resources and information. Many wealthy investors can afford to hire financial advisors or wealth managers who provide personalized guidance. These professionals can help them navigate complex investment strategies, identify lucrative opportunities, and ensure their investments align with their financial goals. Wealthy individuals also place a strong emphasis on networking. They often connect with other successful people in their field or industry and engage in conversations that provide insight into investment trends and strategies. Another characteristic of wealthy investors is their willingness to take calculated risks. Unlike individuals who might be too afraid to invest due to fear of losing money, wealthy individuals understand that risk is an integral part of investing. One of the most significant factors impacting poor individuals' investment strategies is that they often prioritize immediate needs over long-term investments. For many living paycheck to paycheck, every dollar counts. Immediate expenses such as rent, bills, groceries, and healthcare take precedence over investing for the long haul. This financial pressure can leave very little, if any, discretionary income available for investments, making it challenging to think beyond the present. Furthermore, limited financial education can pose a significant barrier for many low-income individuals. While resources to improve financial literacy are becoming more accessible, many still lack a solid understanding of investment options, asset management, and the benefits of different investment strategies. This knowledge gap can lead to a lack of confidence in investing and a greater likelihood of missing out on opportunities that could improve their financial situation. Finally, societal and cultural factors also play a role in shaping the investment strategies of lower-income individuals. Community perspectives on wealth and investment can influence behaviors and attitudes. In some communities, the focus may be more on immediate economic survival rather than wealth building, which can perpetuate a cycle of poverty. The lack of mentorship or role models who engage in investing can also deter individuals from considering investing as a viable option. To illustrate the differences in investment strategies between wealthy individuals and those with lesser financial means, let's look at two contrasting real-life examples. Sarah, a wealthy investor, and Tom, a working-class individual. These examples will help to highlight the practical applications of the strategies we've discussed and provide a clearer understanding of how these two groups navigate their finances. Example 1. Sarah, the wealthy investor. Sarah is a successful tech entrepreneur in her mid-40s who has built a thriving business in the software industry. She has a substantial income, significant savings, and a well-established investment portfolio. Sarah's journey into investing began early in her career, inspired by mentors and financial advisors who encouraged her to think about wealth accumulation as a lifelong strategy. Sarah has adopted a long-term perspective when it comes to investing. Her portfolio is diverse, including a mix of stocks, bonds, and real estate. Rather than jumping on the latest investment fad, she focuses on companies that show growth potential over time. Sarah invests heavily in technology stocks, understanding the industry well and recognizing the long-term trends driving innovation. She also dedicates a portion of her portfolio to socially responsible investing, believing that her investments can also align with her values. Example 2. Tom, the working-class individual. Now let's look at Tom, a 35-year-old construction worker. Tom works hard to provide for his family but struggles financially, living paycheck to paycheck. While he has aspirations to invest and build wealth, his financial reality presents significant challenges. Like many individuals in similar situations, Tom prioritizes immediate needs over any investment aspirations. Each month, the majority of his paycheck is allocated to rent, utilities, grocery bills, and family expenses. With little left over, investing appears to be a distant dream. Unable to set aside substantial savings, Tom focuses on building a small emergency fund to handle unexpected expenses, which he considers critical for his financial security. Tom's knowledge of investing is limited. He primarily hears about stocks and bonds through mainstream media, but lacks the understanding of how to navigate these investments. In conversations with friends and family, he often hears cautionary tales about the stock market, reinforcing his risk-averse mentality. As a result, he tends to shy away from investing in stocks, fearing the potential losses that could jeopardize his already tight financial situation. Tom also faces barriers when it comes to accessing affordable investment options. When he looks into investment accounts, he finds complicated terms and conditions that are outside his understanding, leaving him frustrated. The lack of affordable resources and mentoring further exacerbates his challenges. Tom doesn't have role models who can guide him through the investment process or help him build his wealth. Unfortunately, when minor emergencies arise, Tom might resort to high-interest loans or credit cards, which can quickly lead to a cycle of debt. Without other options available, this reliance on debt can hinder his ability to invest or save, keeping him trapped in a financial rut. Bringing it all together, the contrast between Sarah and Tom sheds light on the broader conversation around investment strategies and financial empowerment. While Sarah represents individuals who have the resources, knowledge, and networks to grow their wealth, Tom exemplifies the barriers faced by those with fewer financial resources. The challenges of immediate financial needs, lack of education, and risk aversion often play a significant role in shaping how individuals invest. In recognition of these differences, it becomes clear that creating pathways for education, access, and community support is essential in bridging the investment gap. Thank you for watching. If you found value in this video, please give it a thumbs up, share it with others who might benefit, and leave a comment down below with your thoughts or questions. Don't forget to subscribe and turn on notifications for more content designed to empower you on your financial journey. Until next time, keep investing in your future and stay financially savvy.